Deep Dive with David Stendhal, where we trade without ego, no emotion, no greed, and no opinion. Before we begin tonight's video blog, please read over our trading disclaimer and remember to trade smart and accept the reality that trading futures is risky. This presentation does not provide buy-sell recommendations, and our information is strictly provided for educational purposes only. As always, trade at your own risk and analysis. Hey, it's David Stendhal with tonight's Deep Dive. It is December 20th, 2017, and I thought I'd revisit sugar, the ETF being CANE. And the reason I'm showing this is because we had a wave low that triggered here in sugar today, and we're showing some major support to the market. And those are the things I'm going to emphasize, at least initially, with our Deep Dive. We have a mixed bag here when it comes to our trends, which you'll see why that's important in just a second. And we have a changing technical overview to the market, which is kind of non-existent for the time being. But if we take a look at sugar on a daily bar basis, this is where that wave low triggered. It's showing that the market should rally, which it obviously has with yesterday's action was a major move. But that major move has kind of given us an indication that this support level that we have right through here actually did hold, and now we're running into resistance at the 50-day moving average. But the support levels are very strong here. We have three levels here. The first one is at 27. This is what we call signal levels, and they represent support and resistance with our interpretation and our strength level. So this one is at 27. And that, I'll just pull up the number for you. It's 1376 for sugar. The next level down, which we go back further, which I believe is a 33. If we look at that one, the support would be 1361, a little bit lower. And then the behemoth here, which I can't see the number on the screen, but that one is at 1343. So we have three levels of support. The most important one to us right now was the most recent. Now ahead of us, we have three major resistance levels, which is what these magenta or purple dots represent. I'll give you these numbers as well. This will be the secondary one, but it's 1548. The next one that we're going to actually run into would be 1525, which is, a little ways ahead of us. That's some good profit right there. I think the point value for sugar is $1,100 a point. So we've got a nice little move potential here. And the behemoth resistance level is this one over here at 1575, this one right through here. So we're kind of at that in-between stage where we're definitely finding support. We just recently ran through this. We have a wave low that just triggered. It's maybe gotten a little ahead of itself. It's finding some resistance here at the 50-day moving average, but things are looking good. When we look at the patterns, I guess what I'll do is I'll first show this. Here's the deep dive pattern, something new that we just added to the market or to the website. So we have deep dive analysis, which was the original. It looks basically just at the market, and then the patterns. There's a slew of patterns that we'll actually look at, and we had a stretch low that just occurred here in sugar. Another reason we're looking at it today. The low represents the fact that it's low and headed higher. If you had a high, it would be high, and you'd expect the market to fall off from that level. These numbers that are next to it, the 0 represents it occurred 2 days, day 0. If there's a 1 or a 2 after the level, the reading, then that means it was a day ago or 2 days ago. And we're talking trading days, not calendar days. So bottom line is that we had a stretch low that occurred here because of the strength that recently occurred here in sugar, meaning yesterday. So if I pull up the next page, again, this is daily bars and it's for sugar. And back on the 13th, I was pointing out in a deep dive that the market had a pop low or a pop bottom, which is what this kind of clear green dot represents. These two crosshairs, the yellow and the green is above it, so that's why the color looks a little bit different. But those were surge lows. Those were profit taking on the downside and an indication that the market was getting ahead of itself. Then at the same time, we had a keel low, which is represented by this kind of very transparent reddish crosshair right here. So we actually had four things. We had two surge lows, which are the yellow crosshairs. We had the the pop bottom, which represented by the green dot, and the keel low. And the keel low represents a market that is severely oversold, and when you have that condition, that's more of an environmental change type indicator, and the keel low means that, hey, the market is severely oversold. You would logically expect the market to recover and head higher from there, which is traditionally what does take place. But with environmental changes, there's nothing that could be said that the market's not going to really pick up and really fall off here. But because of those support levels, it was probably a clear indication that the market was going to head a little bit higher. Now we have, having triggered today, this stretch low. Now, we had that big move yesterday, so it kind of took the wind out of its sails a little bit, but this stretch low means that the market theoretically should be heading even higher. Now, it may have gotten ahead of itself, and it's in contention with that 50-day moving average, but we should see, with given these four indicators here, and the fifth one being today's stretch low, that the market should likely, over the longer term, and I'm talking about weeks now, that it should really start to head higher. If we take a look at our seasonal tendencies, you'll see that this is a 5-year seasonal chart. The blue represents the 5-year composite as to where the market traditionally goes. You can see that currently right now we have some degree of accuracy, which is what this shaded line represents, and this black line represents this year's indication as to where the current year's is trading. So the fact is that we're down. It's not really represented the little surge to the upside as of yet, but we should see a bit of a bounce, a little retracement, and going into the tail end of the year, this would be December 31st or thereabouts, you should see the market rally a little bit, and that's where we're going to probably be headed with some volatility here over the course of the next 2 weeks or so, going to the tail end of the year. Once we get to the end of the year, then we see we kind of flip back to the beginning of the chart, and you'll see that there's a little decline, a little recovery, and then for the most part just a lot of wiggle room until we get into April, well, late March or so, we start to see another trend that should emerge. But for the most part, as we stand right now, it's this tail end of the year strength that we're looking at. Although it is volatile, it's not just straight up, it's not one of these perfect, trending type things, but it is nonetheless kind of biased to the upside. And that's why with the indicators, those patterns that I was showing gives us an indication that the market might have a little more rally to it, and then we'll run into these resistance levels that I was referring to earlier. So the first one you're going to want to look at, assuming we can break through this 50-day moving average, which is what the market is basically stopping at right now, our next upside would be into the 15s, 1525, and then obviously those other numbers that I was referring to. So we'll see where the market's actually able to go right now. The systems had been short, they're now flat, and they're now poised and ready to hopefully get into some type of position here. There could be a little bit of backfill when it comes to the 50-day moving average, which is obviously what we're at right now. But with that being in play, the systems hopefully will start to look to go long the market. If it should fall, I don't really think that there's too much worry because we have so much support to the market, and I think it's probably time to start testing some of these resistance levels. And I think what you'll find is that the 50-day and the 200-day, which is what this gray line represents, are going to be major foes to the market along with these other levels. But if we're able to break through this for the remainder of the year, then perhaps we'll see a different condition start to occur in the early part of next year, and hopefully a new trend will start to emerge. Traditionally, when you get this this stretch low, this reddish mark here, that's when we traditionally see the beginnings to new trends. Not always the case, and I think that yesterday's action, being as strong as it was enough that it took a little bit of the wind out of the sails, but I still would think that that a new trend could start to emerge, at least into the 15s, which isn't that far away, and get to some of those resistance levels. So keep a close eye on sugar. The systems, I could have pulled it up, but I won't do that right now, but they're flat and they're waiting to get into a particular position. So we'll see what happens with sugar, and we will take a look at another market tomorrow. Thanks for watching.